Good afternoon, everyone. This is our February meeting of the CERS Investment Committee. We have a full agenda this afternoon, and so I think we'll go ahead and get started. Could we start with the legal services statement, please? Yeah.
No problem. This is a regular meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61-826, may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you, Eric. Appreciate your making the comment. I guess first item of business is roll call. Sherry, would you please take the roll?
Yes, sir. Dr. Hackbart?
Here.
Mr. Cheatham?
Here.
Dr. Milkman? And Mr. O'Mara?
Here.
Thank you. And Dr. Hackbart, there are no public comments today.
Thank you very much, Sherry. First item of business then is the approval of the minutes of the January 24th meeting. Would someone please move to accept the minutes as presented?
So moved.
Is there a second?
Second.
Any comments or suggestion changes? If not, let's proceed to vote. All in favor of accepting the minutes as presented, please indicate so by saying aye.
Aye.
Motion passed. The minutes have been accepted. Next item, I believe, is I'm going to ask for maybe a switch. I talked to Steve before we started. Maybe switch was actually the 7 and 8 items. Basically start with the 6 and 7, I'm sorry, the investment quarterly report, the best sort of a straightforward report, and then follow that with the discussion about the asset allocation. So Steve, if that's okay, let's proceed that way.
All right, great. Thank you. Good afternoon. I'm going to have, I think David's on. David Lindbergh is going to cover the economic and market update, and then I will cover performance and allocation. So Sherry, yep, I think you're on a couple pages forward. David may want that's perfect. David, I don't think we can hear you if you're speaking.
How about now?
Perfect.
Oh, good. Thanks. Sorry about that. We could go maybe, Sherry, to that next page, 106. Thinking this is a really great place to start. But I just want to say this to the crowd. Chris and Craig that are usually with me as well. Chris is out on vacation with his family this week, but I wanted to let you know some good news about Craig. He is on paternity leave. He and his wife had twins. They were born, I believe, 2 days or a day after Christmas, and they were months premature, and they've been in the hospital until about a week ago, and they are home, and all is really good news. So I just thought I'd let you know that they are taking care of 2 brand new babies that just spent 3 months gaining weight in the hospital.
That's good. That's good, David. Yes.
Yeah. So this page, I'm going to just expand my screen a little bit here. So page 106. This just shows, since Steve will be going through performance for 2023 in the calendar year. This shows you just very high level drivers of return. I'll just take that first column, 2023, the thematic drivers. As you know, from all the discussions we have about bucketing assets, and we'll touch on more of that in the asset allocation work today. But you'll see those 5 categories of growth, defensive growth, diversified credit, real assets, and defensive assets. Defensive assets are your high quality fixed income. Looking at calendar 23, these are the drivers of return. Growth at 22.2. So that's picking up all types of just broad market equity, US, non-US, developed markets, emerging markets, private equity, everything in that category that we consider to be pure growth assets. Those were the 2023 drivers of return, growth assets. Next is diversified credit. We'll talk about diversified credit today quite a bit when we go through the asset allocation policy work that we've been working on. Roughly almost 12.5% return driven from credit strategies within that whole universe. Lower returns from real assets, still quite solid returns even from defensive growth assets at just under 10%. And then finally, pure defensive assets, that being fixed income, high quality, and cash, 5.5%. So a lot of good positives throughout last year. You can see as you go across the quarters how that breaks down quarter by quarter. But drivers of return quite strong coming out of growth assets throughout 2023 in general. If we go over 2 slides to 108, here I'll just quickly show the yield whiplash at the top of this page. This is watching the 10-year nominal, the 10-year treasury rate, and how that climbed up to a peak of up around 5% back in the fall of last year, back down again, up a bit more since then, up over 4%. This rate change, the regime change in rates, which you all know quite well, I'm sure at this point, is a big driver of how the whole economic landscape and asset allocation landscape looks a bit different as we look forward today. And so we talked back in the fall about the asset allocation policy. We'll talk about that again today, but this is a big driver of that change and how rates have moved. If we jump over 2 more slides to 110, this is interesting. This top chart just shows this is market expectations for what the Fed is going to do. So we see about if you go from the top line to the bottom line, March 24, 5.17, we see roughly a 120 basis point or so drop between short-term Fed rates today versus what the market expects by the end of the year, by December of 24. So nothing more than an observation. The Fed did a bit of a pivot late last year and got the market really excited, and this market has been rallying. Market expectations have probably been a bit more optimistic than I think many of us would expect out of what will come throughout this year in terms of Fed rate cuts. So yes, we hope and think there's a good chance we're probably at the top of that rate cycle. No guarantee even on that, but it's certainly a bit asymmetrical and a much more likelihood to be starting to come down in rates. But we are not, from just a strategic standpoint, quite as optimistic as the market is in terms of expectations. So we'll see where that goes this year, but still we continue with strong consumer spending. We continue with rallying equity markets. We have home prices were still up 5% year over year in the announcement just a few days ago. Inflation is yet still beating expectations, so not a real good thing from the Fed standpoint. Dr. Hackbart, you have a question?
You said you're not quite as optimistic about that, or do you have a just slightly different position on the expectations?
Yes. Yeah, I mean, we just think and this is just, the market, we think, is probably overestimating how fast rates will come back down. That's really all it is. So not that we aren't expecting rates to come back down, but we think there's just a bit of probably excitement in the market's reaction to the Fed's pivot late last year, thinking that rates are going to come down. Some are saying like six cuts this year, and the Fed is already backing up a little bit, at least in their language, trying to say, don't get too excited. They're hoping to be able to bring it back down, but we think rates will come down, but we just think that the market is probably a bit aggressive in terms of its expectations.
Yeah, at the end of the year, markets was pricing in 6 cuts in 2024, and that was, as David mentioned, that was following kind of a failure of the Fed to push back on some of that, and that caused the rally into the end of the year and a lot of risk assets. But I think we've backed off of that, and now I think we're around pricing near the dot plot, so around 3 cuts this year. Been pushed out from March. You know, originally the expectation was the first cut would be in March, and I think we're somewhere June, July timeframe now for expectations, at least from a market pricing standpoint, is the first cut.
Yeah.
Thank you. Mhm.
Sure. So if we move ahead one more page to 111, or better yet, let's go out to 116. I'm just trying to hit some real key points here and set the stage well for, you know, what has happened in terms of performance across asset classes. So we talked about growth assets. Here, just a breakdown at the end of last year, quarter, year to date, longer term periods, what returns looked like. The U.S. equity market in aggregate for the quarter up 12%. Last year, calendar year, U.S. equities up 26.1%. That is huge. So if you think about when we talk about in the asset allocation work, forward-looking expectations for the equity risk premium, and that is the difference between stocks and bonds, that is very narrow right now. As we look forward with higher rates and higher returns for fixed income, and then equity prices where they are today, lower expectations for traditional public equities, that difference is really squeezed right now, less than 1% in terms of the equity risk premium. So just an important note to think about, and look at the returns we've been able to enjoy over the past year. And it impacts how we thought about this asset allocation policy that we'll get to in a little bit. So large cap stocks for the year outperform small cap stocks. Everyone knows the story about the Magnificent Seven, continues to drive a big part of the market. So in general, that's what we've had in terms of U.S. equity market returns. If we go out to, I think it is 121 for non-U.S. equity markets. Year-to-date numbers here, similarly, that top line, 16.2%, that's the All Country World Index. EFA right below there are developed markets at 18.9 and emerging markets at 10.3. So stronger in developed markets than we've had in emerging markets. In the emerging market territory, China's been a laggard in terms of driving emerging market returns. So, but still really strong returns out of those markets. And then finally, I'll just go over to 127 and we can look at some fixed income returns. So sticking just, I'm sorry, I'll back that up just a couple of slides. Shoot. Yeah, I'll show this one. This is a good one right here. Just global rates and where they are today. Looking at short-term rates, we see countries like India and Brazil way out there on the short-term rates as well as on their 10-year yields. And then the U.S., you can see now, 2 years ago, bottom left corner on U.S. rates, and now sitting right in there in terms of 3-month yields in between, roughly that 5 to 5.5% range. And of course, an inverted yield curve. So we're looking at, roughly 4% on a 10-year. So those are rates. And then the final chart, which was 127, the quilt chart, just to give a show here again of the last column in the middle section, 2023 year to date, drivers of returns again, equities from U.S. to developed to REITs to high yield. Just coming down the page, you can see where the strong returns were from. Core bonds, 5.5. Core bonds, 5.5 versus last year in 2022. If you move over to the left, they were down 13% from rising rates. And looking at equities, last year, 2022 was the year with all the correlation between stocks and bonds. Mostly of all these things, with the exception of commodities, were negative. So really tough year in 22. Strong reversal, a lot of that in 23. And if you look at the 5-year annualized, we still have U.S. equity markets from a valuation perspective, higher valued than any other markets around the world. And if you just look at even a trailing 5-year return in the mid-teens like that, 15.4%, that would suggest that most likely these valuations are quite high today. And in fact, we think they are. So that's, sort of the stage, I think, for where Steve will go with looking at performance and the kind of year that we had across asset classes and markets in 2023.
Thank you, David. Sherry, if you could go to 129, please. Thank you. We continue to make enhancements to our quarterly reporting process, and starting on this page is the new format that we rolled out last quarter, which we hope provides more useful information in a more user-friendly format. I think David did a good job of providing the backdrop to the quarter. Markets across the board rebounded sharply, as he showed, between the third quarter and the fourth quarter of the calendar year, on optimism that earlier and larger cuts in interest rates would usher in kind of what we've talked about as the Goldilocks period of really steady growth, moderating inflation, and easing financial conditions. That's that soft landing, no landing, kind of threading the needle that the Fed is trying to accomplish. Still have a lot of work to do, as he mentioned. The CERS and CERS hazardous pension portfolios performed well during the quarter, with returns of 6.78% and 6.85% respectively. The insurance portfolios produced similar performance, with the CERS portfolio returning 6.87% and the CERS hazardous portfolio returning 6.71%. All of the portfolios outperformed the benchmark, which returned 6.45% for the quarter. January performance is expected to be finalized this week. Preliminary estimates indicate that all of the portfolios were up about 10 basis points, and the benchmark was flat, so a very muted month from a performance standpoint. And that really was driven by kind of mixed performance across asset classes. U.S. large cap equities continued to perform well, especially growth, and posted positive performance for the month of January. U.S. small caps and non-U.S. equities struggled and posted negative returns for the month. Core fixed income was modestly negative as rates started to inch up. As we discussed, we began the calendar year looking at 6 rate cuts for the full 2024 starting in March, and that's slowly been pushed back. Some of that talk by the Fed, some of that based on a little bit hotter economic data and sticky inflation prints. Real estate for the month continued to struggle and was the worst performing asset class, while specialty credit continued its rebound and was the best performing asset class for the month of January. February, we're almost finished with, just got the leap day to contend with, and started with markets remaining pretty soggy from January, trading heavy across the board, but they've continued to firm over the month as rate cut expectations moved out from March to June. And Fed officials warned against that overexuberance of expectations of policy easing, and economic data, as I mentioned, continued to surprise to the upside with a stronger jobs report, higher CPI and PPI. Public equities, and this is a little stale already before today, were broadly up between 4 to 5% for the month of February. Core bonds are down modestly as we continue to see a pullback in yields. As David mentioned, we're back above 4%. Loans and high yield are up for the month as we continue to price in a benign outlook for defaults, and spreads continue to compress. Real estate and broad commodities have continued to lag, and as of this morning, we're still down for the month. The current performance estimates for February show the portfolios up between 175 and 200 basis points, but obviously that's likely to change here over the next day and a half. Page 143, please. This is part of the new report that we include on a quarterly basis here, and these are a few of the investment highlights from the first half of the year. And I'll just highlight that the big things were across a number of legs. Staff was able to rebalance the core fixed income portfolio during the first half of the fiscal year, moving the duration of the overall portfolio from 3 years short relative to the benchmark to essentially flat duration relative to the benchmark. This included changing the benchmark from the Loomis portfolio from the intermediate ag to the full U.S. ag. A total of $1.925 million was transferred from the $1.925 billion was transferred from the Lord Abbett short duration credit portfolio. with 996 million going to the existing core portfolios, the two managers, Loomis and Nissa, and 928 million to the new internal passively managed core portfolio. Specialty credit managers continue to find compelling opportunities, as we've discussed about over the last several quarters, deploying over 150 million during the first 6 months of the fiscal year. And that included the first capital calls for the new approved Adam Street fund and co-investment vehicle that were approved in 2023. Across insurance and pension, across the systems, a total of just under 300 million was called and invested by real return managers. The majority of that were the initial investments for Arctos and Maritime. And those are the two of the new real return managers that were approved in 2023 as well. Additionally, I wanted to highlight that so the first proxy voting report was posted to the KPPA website, and that was posted after the last quarter. So we're happy that we were able to meet that statutory requirement. All of the proxies that were eligible to vote are being voted in accordance with the CERS proxy policy, and the proxy voting report will be posted to the website on a quarterly basis. Page 144, please. As noted, the rebalancing of the core fixed income portfolio resulted in the termination of the Lord Abbett short duration credit portfolio. The account is currently in wind down and holds a single CMBS security. No fees will be charged on the account, and the account will be closed and the agreement terminated once the security is either sold or matures. As shown on the next page, 145, this Lord Abbett portfolio performed well. It's not, there was nothing performance related to it. It was simply part of the rebalancing of the overall portfolio. It served the intended purpose and provided positive contribution to portfolio performance, both relative to its benchmark, but more importantly, it provided significant outperformance compared to the overall core fixed income benchmark. For the 3-year period, the core portfolio overall has outperformed the benchmark by 381 basis points, which is pretty impressive for a core portfolio. The 6-month rebalancing period, so the start of the first 6 months of the fiscal year, that rebalancing accounted for positive 160 basis points compared to if we had not rebalanced the portfolio. So timing wasn't optimal, but we had implemented that, started to move take off that short duration as we hit our targets on yields, and we thought that the yield environment was more compelling to be longer duration. The addition of the internally managed portfolio is anticipated to save between $1.5 and $2 million per year in fees. And we've already started discussions with Wilshire and are undertaking a strategic review of the core fixed income portfolio to determine the appropriate allocation among strategy styles and managers, and that's consistent with the objectives for the core portfolio, providing diversification, downside protection, liquidity, and producing excess return. I'll pause there if there's any questions.
I guess just a general question, Steve.
Sure.
Have you had an opportunity to reflect on, we had a strong fiscal year ending last July, and we've had a strong calendar year. Have we seen any movement in our funding ratio, or have you had a chance to review that to see if we're seeing some positive movement there as a result of the relatively strong investments results and performance?
I've not seen any. Dave may be able to comment, but I've not seen anything come out. But obviously, that's performance is helpful in that regard.
Yeah, the next valuation will be as of June 30, and we'll get a glimpse of it in October, and kind of the final numbers in November. So we aren't June 30 yet, but I would be hopeful. When you see any numbers printing at better than 5.5%, you can generally assume that it's going to improve somewhat.
Good.
So we got year to date at 2.5. Not too exciting, but
Certainly. Okay. Thanks, David. Yeah.
Page 146, please, Sherry. For the quarter, the largest contribution to outperformance of the portfolios was the underweight positioning in real return and private equity, as well as the relative outperformance of the private equity portfolio. The most significant detractors from performance were the overweight to specialty credits, which we use as the proxy for the current underweight in real return, as well as the relative underperformance in the specialty credit portfolio. In that specialty credit portfolio, the public high yield bonds and private credit components were all positive contributors to relative performance and performed in line or outperformed their respective benchmarks. The real detractor there were the mandates with structured credit and mortgage-backed exposures, which were a drag on overall performance as they failed to keep pace with the rally over the last 3 months. Outperformance in real return allocation has been paced again by the portfolio's MLP exposure, which has returned over 12% fiscal year to date as strong cash flows, disciplined CapEx and consolidation have continued to benefit the industry. Page 154, please, Sherry. Always one of my favorite Wilshire produced charts. And while Wilshire's peer universe, we've worked with them some on refining or potentially refining what the peer universe were compared against. And I think part of the CEM benchmarking that Dave and Rebecca are doing will provide some additional insight there. This is a pretty broad universe, and obviously that means that it encompasses a pretty diverse set of asset allocations. And while providing a good perspective, I think it's always good to kind of give us a benchmark here relative to how other plans are performing. The return and risk rankings, as we see in the first two graphs there, for the CERS portfolios for any discrete period of time are really largely going to be driven by the overall market performance and the differences in allocation compared to other plans in the universe. We tend to have a lower risk profile than other plans in this peer universe. And so during periods of strong performance, the CERS portfolios will tend to lag. But I think more important takeaway from these pages and the area where I really focus is that graphic on the far right, which is the ability to consistently produce superior risk-adjusted performance, been able to achieve that over time with all of the portfolios producing top decile Sharpe ratios or risk-adjusted performance measures. So I think that's really, to me, one of the things that stands out is the consistency of that risk-adjusted return. Obviously, we work with the investment committee and the boards and Wilshire to determine the appropriate asset allocations. That kind of gives us where we're going to be, largely driven. We can add alpha on top of it, but as we know, that asset allocation is the most significant driver of performance. We're benchmarked here against some plans that have more aggressive asset allocation. So in strong markets, we're going to kind of appear further down the graphs, but on that far right, that risk-adjusted performance and the consistency of that top decile rankings is quite impressive. Page 162, please, Sherry. Thank you. As of the end of the quarter, all of the portfolios were underweight real return as they have been for the last several quarters, with corresponding overweights in specialty credits. Again, that specialty credit overweight is serving as the best proxy for that real return asset class, given risk and return profile, similar risk and return profile, and correlations with what we see is kind of the assets that are in that real return bucket. We continue to work towards bringing all of the asset classes in compliance with the IPS allowable ranges and towards their established targets. Capital was continued to be called in real return managers that were approved last year, and as indicated on the graph, we anticipate the remaining committed capital for these strategies will be called over the coming quarters, moving the portfolios closer to their targets, and that's that pro forma number there. But I would note that pro forma that's depicted on the graphs here does not include the investment with Saba that would be in that allocation that was approved by the IC, but still needs to be ratified by the board. So that is not included in that pro forma number. As I like to point out, for the quarter, the allocations that were outside of the specified ranges, I think that's really a question that I'm sure is on your mind, is for those asset classes that were outside of the ranges, so not in compliance with those IPS ranges, what was the impact on performance? And for this quarter, it was a modestly positive impact on performance, contributing between 36 and 38 basis points of positive outperformance. as the negative impact of the overweight and the proxy specialty credits was more than offset by the benefit of the underweight to the real return asset class. And if no questions, we can move to page 176, please. Thank you, Sherry. We continue to make enhancements to this compliance report as well as the overall compliance reporting function. Our hope is to increase transparency and ensure that the IC and the board have all of the information they need to fulfill their governance responsibilities. I would highlight on this quarter's report, we are noting 2 areas that were not in compliance. As of the end of the quarter, the amount of public equities passively managed by KPPA staff exceeded the 20% limit of the IPS by the amounts noted here on this page. This was what it was typically we refer to as a passive breach and was a result of market appreciation of the internally managed passive public equity portfolios, which are largely dominated by U.S. large cap growth equities, which is David highlighted has been the best performing asset class. So on a relative basis, they've appreciated more than the other assets in the portfolio, and that's caused them to breach that 20% limit that's specified in the IPS. We have been using broader rebalancing of the public equity portfolios to decrease that over allocation, and we'll continue to use rebalancing trades to bring the portfolios in line with this constraint. We would anticipate that should be completed by the end of this quarter. Page 179, please, Sherry. There we go. Additionally, on this page, we noted the portfolio allocations that were not in compliance, as we talked about, with their specified IPS allowable ranges, which are specialty credit and real return, and showing here the amounts that they were under or over their thresholds. If no questions, we can move to page 181, please. Just an update on the investment budget. Through the first 6 months of the fiscal year, actual expenses are running well below the amounts budgeted for the year, with 75% of the amount budgeted for the year still remaining. While expenses to date for the majority of contracted services are in line with the amounts budgeted, the most significant divergence is obviously in that legal services category, where only 12% of the amount budgeted for the year has been spent. Talking with legal and Michael and Vicky, we anticipate a significant increase in legal expenses in the second half of the fiscal year as litigation activity picks up on a number of cases. I'd also note that the BNY invoicing looks a little strange in that it has been delayed and through the end of December, only 1 quarter custody invoice had been paid so far in the fiscal year. I think we've caught up with BNY, so this quarter you'll see 2 invoices paid, and as of the end of the third quarter, 3 will have been paid, and we'll be back on track. Page 184. Investment fees and expenses are running well ahead of the same period last year, but significantly below the 2022 levels. Management fees have been relatively stable across all asset classes, with any fluctuations really driven by market value changes and allocation changes. The volatility in overall expenses has largely been driven by swings in performance fees, and that's consistent with what we've seen over the last 3 years. Volatility in markets and kind of the corresponding impact on performance and thus on the performance fees. The largest increases have occurred in specialty credit and private equity asset classes, while real estate has continued to see erosion in performance fees. We've also seen, as we'll note, a sharp rise in the miscellaneous expense category, and that's primarily for for strategies that rely on credit facilities. And again, given the sharp rise in rates, especially on the front end, those credit facilities are just more expensive to operate. That's all I had for this section. I'm happy to answer any questions.
Any questions?
Steve, I have 1 question
Bill,
Sure.
please.
and then 1 observation. You said the Lord Abbott, we were 3 years under benchmark.
Correct.
We're now at benchmark. Well, what is our benchmark?
The benchmark is the Bloomberg US Aggregate Index. and that the duration of that index will fluctuate.
And what is it now?
It's a little under 5 years.
Okay. And then if I could, we're gravitating toward the allocation discussion. I found it helpful to look up what our actual allocation was, and I finally found it on page 131, in the same order that the allocation presentation is. So it helped me to go over, and I looked at the CRS non-haz, that we're at 51% equity and 7% private equity, with a 20.2% specialty credit, 10 core fixed income, 1.6 cash return, a real estate at 5.7 and real return at 4%. And compared that to our target, which is before we started talking about where we might want to move under the proposals. So I made a schedule that started with our current allocation, compared it to our target allocation, and then showed the proposed risk A and risk B. And then I added the risk factor, which was on page 35, and would welcome that discussion of that risk factor to help us evaluate the movements that are being proposed and where we are now versus what our current target is. So I needed to put all that in front of me in order to kind of have this discussion in my mind.
Sure. No, I think that makes sense. And are we assuming we can start the discussion on the asset allocation? Happy to start that now.
Let's kind of separate if we could to, if we're through with the reporting with Steve and Dave, any other questions besides Bill's?
Yeah, I have a few questions.
Sure.
Bill, if it's okay, let's hold your question because it probably
Sure.
filters back
Sure.
into the asset allocation discussion we're going to have in a few moments. Yes, please proceed.
Okay. I'd like to back up, Steve, if you want to go to your page 150. I know
Okay.
we reviewed the quarterly performance numbers as far as fund attribution. We didn't cover what the last 12 months were.
Sure. The majority, obviously, the biggest driver here is, and we've talked about this in the last couple of investment committee meetings. The largest driver, obviously, is the of underperformance, is that relative performance of the private equity portfolio. And as we've discussed, that really is largely driven by a benchmark mismatch. The benchmark for that is a public equity lagged index, which is not really reflective of the actual performance of what private equity markets are doing.
But you're using the same benchmarks for your quarterly report, correct?
Correct. There's always going to be variations. That's yes. So there used to be a short-term and a long-term benchmark for private equity that was removed in, I believe, the last IPS. And the old short-term benchmark was the actual performance of the portfolio, because the focus for private equity, obviously being a longer-term asset, was that it should have more of a performance objective. Whether the benchmark that was adopted is appropriate or not, I mean, I think that's an industry question within the industry. There's not necessarily there are some private equity benchmarks that are composed of private equity investments, but it's not universally accepted. It's not atypical to see a lagged public equity benchmark used for private equity. But yeah, that will cause pretty significant swings in relative performance or performance relative to a benchmark to utilize that type of benchmark.
You indicated that you brought just shy of $1 billion back under internal management that came out of Lord Abbott, correct?
Correct.
of the 16.6 billion in assets that we have, how much is being managed internally?
Internally across the board,
Yes.
across all asset classes.
Yes,
So that would probably be about 25%.
How much was that, Steve?
About 25%, that's public
25%.
equity. That's, yeah, that would be across public equity, across liquidity, and across core. I can
So-
get back to you on the specifics of that.
In dollar terms, we're talking about somewhere in the neighborhood of about 4.5 billion. Is that correct?
That would roughly be correct, yes.
How many we have in the office these days?
We have, on the investment staff, we have 4 individuals, including myself.
And it may be on one of the other pages that we didn't cover. If it isn't, do we have somewhere a performance report by manager? I'm
That
sure
is
you
included,
probably got it internally.
Yep, that is included in the deck. Find the page on that. Starting on, it looks like 166.
Okay.
That's
Is
by
that
plan.
report-
The plan to go to the next page, we'll start to see managers.
Okay. I'll go back and review it.
Yep, that's every manager, every portfolio in the allocation.
Does that include what the internal management?
That right there on that page, bottom of that page, internal US mid cap. That's one of the internally managed public
Okay.
equity accounts.
But that's the only one, that segment?
It's not the only public equity, no. The scientific beta and the S&P are also internally managed.
All right. I'll go back and review those individually then.
Okay.
Any other questions? If not, Steve and David, thank you so much for your presentation. It was clear and very well done. Appreciate it very much. So I think now we can switch to the next item on the agenda, which is the asset allocation recommendation. Just to put things in context, I think most of us recall that we took up this topic in the January 24th meeting. And at that time, after considerable discussion back and forth, it was decided that we would prefer to have a more in-depth discussion of specialty credit training before we made any decision about reallocation of our assets in our portfolios. So that has occurred. So we now have it back on our agenda for this afternoon. And so I think we can switch our agenda item to the asset allocation recommendation. And recalling that Bill had a question in deference to that to move along effectively. Maybe we could deal with Bill's question first and then move through the formal presentation, if that's okay.
Well, my question was an observation. I just needed to get grounded before talking about the alternatives as to what the current target was, which is on page 37. But I had to go to page 131 to find out what our current buckets were filled at, so that I knew where our current holdings were. And for specialty credit, it's a big difference, a 10% target versus a 20% actual. Equity at 58 versus the 60. A real return at 4 versus a target of 13. So I just had to get that as a base point for us then to go into the allocation discussion. And I just thought I'd bring those forward as reference points.
Bill, embedded in your statement is, it sounds to me like there's a better way we could display this for you. So you didn't have to do some walking
Well,
around.
Yeah, I like the table I created. But it's where are we? Where are we supposed to be? And now let's talk about where we're recommending going. So that's the way my logic flowed. And so I thought it would be, that's the way I thought about it.
We can circle back to you, get your thoughts on an ongoing basis.
Well, I think specifically for this, the issue is what's being recommended, the target recommended versus the current. So I don't think it's necessarily something that we would be presenting at every investment committee meeting. Hopefully we're not presenting a new asset allocation recommendation at every meeting.
Okay, all right, Steve, I mistook that direction.
Yep, that's all right. I'll provide a bit of an overview in addition to Dr. Hackbart's comments, and then hand it off to David, and we can jump into however he wants to, and the committee wants to handle the presentation. But as we talked about, capital market assumptions have changed pretty materially since the last asset allocation analysis was performed. I believe the full asset liability was performed in November 2020, and the asset allocation standalone work was done in November of 21. At that time, return opportunities were pretty limited, as we know, and forced many pension plans, including CRS, to shift out the risk spectrum in order to build portfolios that were expected to achieve their assumed rates of return. The most notable changes since that study has been in the expected returns for fixed income and other asset classes that have a yield component to them. And that's obviously as rates have risen sharply and rapidly from their former zero bounds that they were stuck at for a number of years. These changes in market conditions and expected risk and returns really warranted a review of the existing asset allocation, and in our view, provide an opportunity to construct efficient portfolios with meaningfully lower expected risks, higher Sharpe ratios, while maintaining similar levels of expected returns and improving liquidity profiles for each of the portfolios. We believe that these allocations should help to mitigate the risk and potential magnitude of significant drawdowns in the portfolios, should markets at some point experience large sell-offs, while also improving the probability of achieving the assumed rates of returns of the portfolios over the longer term. That's kind of a high level overview of what the process was to get here. Obviously, there's a lot of work that Wilshire does behind this, a lot of modeling work, both on the asset class assumptions as well as building those efficient frontiers. And I'll turn it over to David to jump into that and answer questions.
I guess my question is, when you talk about risk, I assume you're talking principally about volatility risk. What other types of risk have been considered? For example, with specialty credit, obviously there are many types of risk. How many of those and which ones have actually been evaluated and their impacts and projections?
Steve, I could offer a little bit on that.
Yeah, go into what you utilize to
and
build the
sure.
expected risk of each asset class.
Like I think we just did the educational session on specialty credit back earlier this month. And as I think about it, so first, a good reminder is that when you talk about specialty credit, there are really two things in that component. Half of that is private credit and half of that is public credit. So they're very different, and they're together in an allocation for you, which is totally acceptable. Just understanding the two are two different things. In terms of the risks of all of those in our capital market assumptions, those are taken into consideration. So if you think about, and some of that breakdown is not in the detail in front of you here, but in our capital market assumptions, for example, for high yield bonds. So that's part of your specialty credit allocation that would be on the public market side. We, if you read our annual paper on how we develop our asset allocation assumptions, we step all the way through those with looking at expectations for default risk and then expectations for recovery from defaults. And all that is built into the assumptions that we come up with for publicly traded below investment grade fixed income. So yes, the volatility measure is there, but there's a lot more embedded in that whole assumption process for default and for loss. Similarly, with private credit, there's a similar process there as well. And there's also a lot about implementation. Much of what we talked about in that educational session earlier this month is within the implementation of private credit, manager by manager, with every one of those due diligence analyses that you go through in picking a private credit manager, you're looking at their history of loss and their ability to withstand, market downturns and all those kinds of things. So, like at the very micro level, a lot of that is built into those capital market assumptions. Then at more of a macro level, we in all of this work, and we presented a whole bunch of this in a bunch of these simulations. In fact, back in the November investment committee meeting, we account for all different return paths that will get you through, say, a 5-year and a 10-year period. And in all of those return paths, we're looking at thousands of simulations of possibilities that could position you with, say, one policy versus another having better or worse drawdown risk. So while we look at volatility and we look at long-term expected returns, we also focus a lot on the shorter term. What's the potential for drawdown risk? So meaning how much can you lose in a short period of time? Because a lot of investors, a lot of portfolios can be positioned in a way where they may be positioned to meet a long-term expected return target, for example, but the path in which they get there might be something that they can't stomach. So that is all addressed with a lot of robust activity in the simulations that we do overall. Big picture here that you're looking at is, and we'll come on to these in just a minute, is that you're looking at policies that reduce that overall volatility, forward-looking expected volatility, and that reduction will relate right into all those other things I've talked about. It's going to improve drawdown risk. It's going to improve your ability to withstand certain market environments, et cetera. So, that's a lot of, I think what we talked about back in November was that we've had a regime change. We are in a different position today than we were 2 years ago. Fixed income provides much more utility now than it did 2 years ago. That equity risk premium is squeezed very narrow, as I mentioned earlier when we were talking about capital markets. So as we look forward over 10 years, we're finding that there are opportunities to reduce risk substantially without impacting the return, the expected returns. And that's over the next 10 years. So that doesn't mean that it always stays just like that. But as we look forward over 10 years, that's what we're seeing. So we talked about that earlier in 2023, and then in November, in that investment committee meeting, we went through those different policies. And we'll go to those here in just a minute. But that was the sort of the thematic override of this whole thing, was that you have the opportunity to do that. And so we think that's a good opportunity. Many investors have had that opportunity in this regime change. And, there are options here for you to consider that help you take advantage of that.
Well, it seems to me that, maybe you're giving quite a bit of focus on volatility risk. If we're talking about a 20 or 30-year horizon, we look at long-term trends, I think, are critically important. We're going to have volatility within the 20 or 30-year period. Are we being overly focused on volatility risk as opposed to other types of risk that might be relevant to some of these other investment opportunities?
I don't think, for our approach from this, one of the things that we've always talked about is volatility is just one measure. Just as you say, Dr. Hackbarth, that's one thing to focus on. So we're also very focused on that drawdown risk. We're very focused on, we'll show our growth and inflation factor exposures here to us. That's important as well. A lot of investors will just look at volatility risk and they'll look at changes in volatility, and that's all. But one of the things that we've noted strongly all the way back to the end of the credit crisis, 2008 time period, is that investors often are heavily driven by one economic regime, meaning they're going to do well, when growth is positive, and otherwise they're not going to do well in other regimes. And so we'll go to these bubble charts in a minute where we show that the policy recommendations that have been presented to you actually are improving those other measures as well, so that you can be modestly less reliant on just one economic factor. I mean, in a perfect world, you'd be able to be balanced across all those economic factors, but to be perfectly balanced, there's almost no return available at that point. So we'll talk about that in a minute. But yes, it's more than just volatility for sure.
Yeah, and I think Wilshire does a good job of showing that. I think we consider it in terms of, what's the potential liquidity impacts on the portfolio. But if we looked at, I think that the two metrics that tend to be more, they take into consideration quite a bit is, when you boil it down, is that expected return, encompasses for high yield bonds, as David mentioned, defaults and loss given defaults, right? I mean, it's the return that end of the day, $1, you get $1.20 back, right? I mean, it's the expected return that takes into consideration anticipated losses, again, based on expectations, based on modeling work. But that kind of, to Dr. Hackbart's point, looks at, it's not just a volatility, right? Because the volatility is the volatility of that return. And what's the return? The return encompasses the prospects for potential losses as well.
If I understood Bill's comment, which I thought was very interesting, in effect, we currently are significantly overweighted in specialty credit. Is that correct?
That's correct.
And the overweight is about similar to the recommendation coming forward.
Yes. And in fact, this, if we look at this recommended allocation, it actually moves us very close to the two prior allocations. So before the most recent changes in the allocations were made that significantly increased the public equity exposure and the real return exposure, that specialty credit was more in line with the recommendation than it is with the current target allocation. Again, that was in an environment where, CERS portfolios and many pension plans were having to extend on that risk spectrum in order to achieve those assumed rates of returns instead of bringing down those assumed rates of return. In the specialty credit, in a background that we have previously provided, obviously that we had an allocation to specialty credit. There was an opportunistic credit mandate that was pretty large. And when that opportunistic bucket was eliminated from the asset allocation, that mandate was reclassified into specialty credit at the same time that the specialty credit overall target was pretty significantly reduced, which in part led to, at least at that point, a pretty significant overweight specialty credit. And the corresponding underweight was the result of the significant increase in that real return target. At the same time, if we'll remember, there was a very large Putnam, essentially a Putnam 60/40 mandate that was classified as real return. The decision was made that was not a real return mandate. That mandate was terminated, which significantly reduced the allocation, the already underweight allocation to real return. So a combination of those. And so we've maintained that overweight in specialty credit as we look to build out the real return, because we view that as a fairly good proxy asset class. While we source managers, investments and fund, and that capital gets called in real return.
When was our last adjustment? It's probably about a year and a half, 2 years ago.
The last assets allocation change was in November 2021.
And we shifted significantly over to public equity, correct?
Correct. Yeah, that's correct.
By about, 4 or 5%, was that correct?
I think it was more significant than that.
How has that performance been? How have we done in terms of that reallocation?
The reallocation, I mean, it's, is that, I can't remember what the graph that David showed. This all has all the colors on it, but public equities have done well. I mean, obviously been pretty volatile over that 2.5 year period, right? But I think overall that's probably done pretty well. I haven't looked specifically at the change in relative to what
Yeah.
the prior asset
Yeah,
allocation
I
was.
went back and looked at it. It seems to me we've done very well actually with that shift.
Yeah.
Which brings my question is, why are we proposing a shift to private or special credit when our reallocation of about 2 years ago or better really helped our portfolio?
But I think the basis for the change is on what's from this point forward, what are the expected returns for those asset classes?
But in the future, we don't know much about the future.
Well, I mean, I'll just add, as we look forward, like one of the things we do know is that what we just experienced will not be what we experience going forward.
Right,
And
right. Mhm.
and in the forward-looking capital market assumptions are very thoughtful about the relationships between asset classes and also the levels of valuation today. So when we, for instance, now our forward-looking assumption over 10 years on U.S. equity in particular is 5%. Will we be exactly right on that? Probably not. We may be off. Who knows how much? But I mean, the relationship between that and other assets is what's really important. And so, just when I mentioned earlier about the risk premium being so squeezed, so yes, if we measured back to whatever that moment was in the end of 21 through today, I think you have benefited by the fact that you've had heavier public equity allocation during that time. But valuations today are entirely different. So as we look forward, and none of this is about being tactical anyway. If we were being tactical, we would probably be suggesting that non-US equity is a little better place to be than the US markets. But without even doing that, just from an asset allocation standpoint, equity valuations are very strong today, and fixed income rates are now high. So the much more predictable yield to maturity return in fixed income is strong. Specialty credit then steps out as an extension beyond that. Specialty credit, again, publicly traded credit, high yield, things like that. But then the private credit, those areas, more growthy of an asset, but not as growth oriented as pure equities. A much different place, as we talked about in the educational piece earlier this month. But much of that private credit is a claim on the most senior layer of debt within these private companies, and so it's less liquid, but it's it's higher in the capital stack than the equity position is. So I think some of this is like looking back and looking forward are two different things. If that's helpful.
But we are changing our policy forward, right?
Well, the recommendations in front of you, and maybe we just walk through those. So would it be helpful if we just step through those again on
Well,
this slide that's in front of us, 37, just to highlight the things that are changing here. If we start at the top in the total equity section, this is the KPPA approach to bucketing. We have other slides that follow that are Wilshire's approach that just address one thing, and that is that we have a defensive growth category where we house specialty credit. So you can just stay right here on this slide. So the total growth, most growth oriented assets, public and private equity, are in the recommendations here. If you take lower risk A, for example, I'll just focus on A. That's a reduction of 7% from 60% down to 53%. And then those trade-offs, you can see where they are below in the fixed income category, or fixed income stays where it is. That's the investment grade specialty credit. Yes, as you've noticed, that goes up to 23%, which to Bill's point is closer to your current allocation today. Cash goes up a bit. All of this, none of this was developed in order to get to current allocations. This was developed from just a broad perspective across the asset class assumptions. How can we reduce risk without impacting return, because we know that we have that opportunity today with the changes in rates and the changes in equity valuations. So, if you go to the bottom of these columns where expected return on the current target is 6.95, looking forward 10 years, lower risk policy A has it at the same, lower risk policy B is actually a little bit lower risk, few basis points lower return. But the standard deviation of return in lower risk A drops by over 100 basis points. So this is just showing from that mean variance perspective, with a better mix of assets, how can we impact our ability to achieve these returns and yet still take some lower risks. So fixed income goes up. That's the specialty credit allocation primarily. And then the inflation protected component is actually coming down a bit. Real return goes from 13 down to 7, and real estate goes from 7 to 5. So all of that is done in a holistic way, not with a focus on any one of those things, but in a holistic fashion. So those are the policies that you went through in November. And then, of course, with that specialty credit significant increase, you wanted to pause and go through an educational step on that, which is what we've referenced here several times. So it's coming back to these policies and looking forward, and can we allocate in a way that is more efficient than how your current allocation is structured? And we think you can.
David, I hate to return to the same topic, but I guess my real question is, are you overweighting the importance of volatility risk in your risk calculations? Again, we're long-term, 30 to 40 years.
Sure.
I don't think we need to be terribly concerned about volatility risk if that's a major determinant of your risk calculation. If so.
Well, yeah.
Okay.
So it's a determinant. It's not the only one. And we're not, we look at longer term 20-year and 30-year expectations as well in terms of returns. You can see those 30-year expectations on here. One of the other things, I think, if we go out to maybe just to get off of that volatility topic for a minute and look at the bubble chart, which is about 4 pages out. I think this will be, yes, right here. So we look at this chart. These are the two, one of the things that we've talked about for over a decade with our clients and with asset owners is that this is totally separate from that volatility. To your point, Dr. Hackbart, there are two economic factors that drive portfolio returns. It's growth and it's inflation. And in each of those cases, it's rising inflation, falling inflation, expanding growth, recessionary growth. If you look at the crossbars where cash is, and you'll see that purple circle right there, straight up from the zero on the bottom axis, a pure cash portfolio with no volatility to it whatsoever, sits on those crossbars. In a perfect world, if you could get there and still have return, because you do need to meet a certain level of return to meet your objectives, that's where you'd want to be, because that crossbar suggests that no matter the economic regime, we're going to be equally weighted to all those regimes. So we can't do that, but we focus on this as we evaluate policies and what are the different exposures that we have to these economic regimes. So as you move out to the right and you see all these bubbles, the most, take private equity to the far right, the largest bubble, highest returning and most growth-oriented asset class. So as an example, and then we look at things like real return up at the top of the chart. That category and its components have the best reaction to rising inflation. So how do we deal with all of these economic exposures and still obtain a level of return? If you look at where it's marked current target, your red circle, that's your current target. And so without even addressing the volatility, we're able to reduce that economic exposure just a little bit to growth, meaning that the portfolio can be less reliant on one thing to happen, and that being rising growth. And so you'll see in lower risk A and lower risk B, those circles move a little bit to the left. It's not a lot, but it's an improvement in that direction that helps the portfolio to be more diversified from an economic regime exposure perspective. And we're still doing that with, close to a 7% expected return. So we do think it is much more than just volatility. This is important. These economic factor exposures are important. Drawdown risk is important. We talked about that, and it's a bunch of that is in the simulation charts later in this deck that Ned from our asset allocation team went through with us in the last meeting. So I'd say, Dr. Hackbart, we certainly are not only focused on volatility. In fact, it's one of the things where I think we probably differ than a lot of different, asset allocators, modelers, and things in the marketplace, is that we've said for a long time it is not only about a mean variance analysis.
All right. I think, Dr. Hackbart, maybe it's like like Mr. O'Meara said last meeting, like we should just start at the beginning of a bit, go back a little bit to why we are here. Like the mean variance model is almost a 70-year-old model that Harry Markowitz came up with and won a Nobel
What were
Prize
you
for.
suggesting, Anthony?
Yeah, I'm just saying about the model. The mean variance model that David's talking about is a kind of a big model that's used in investments, and it's almost 70 years old. The proponent won a Nobel Prize for it. And you have to use the variables somehow. So obviously it's return versus risk, and the variable that's chosen is volatility, right? Or standard deviation, which, is the perfect variable? No, right? Like I was trained, risk is, the permanent loss of capital. That's what that really is. It's not volatility. But, when you have to make a model and try and do this to help determine our allocations, we have to do something, right? So the x-axis of this just happens to be volatility. It isn't saying, we're just only looking at volatility risk. Like all the risks are put in the returns that people have. Like we assume in this case, especially credit, we think now, or at least Wilshire thinks now, maybe it's going to make in the 7 to 8 range. I'm not looking at it right now, but before a few years ago, it was 4.5, right? Because rates are nothing. So if you make some amount on top of that for taking credit risk, 4-ish was not super interesting a couple of years ago. Now it's 7 to 8 and well above our assumed rate. So that is what makes it more interesting. And that's just, the model is going to like that, right? It's not, it's not because it's just basically the math of it, right? The interest rates went up a lot. You get some spread on top of that, and the nominal returns are a lot better. And so, but yeah, embedded in that, getting the return is going to be losses, right? Because every credit strategy is going to have losses, right? So that's going to be embedded in there. It is taken into account. It just isn't seen on this chart, right? It's a lot simpler when it just is boiled down to a return versus volatility chart. But there's other things I think that you're concerned with are in there. Does that make sense?
Yeah, I understand. Well, maybe we could proceed and go to your recommendation. Would be okay, Steve?
Yes, yeah, let's go ahead. What page is that, David?
37.
So as David mentioned, the two recommended portfolios here are obviously they have slightly different characteristics, and the objective was really to, as we've been talking about, reduce risk, maintain liquidity, and maintain the current level of expected return that the current IPS targets allow. So really the efficient frontier modeling comes up with this lower risk A and lower risk B model, and slightly different. So the preference that we had, obviously we wanted to present you with options, but one of the things we want to shy away from as much as possible is where we can, especially given where the current allocations are, making substantial changes. So that's one of the limitations, as you'll see on that public equity when we talked about this at the last investment committee meeting, is if we were to go untethered on an efficient model, it would allocate at some point it would allocate 0% to public equities. And that's not something we wanted to do. So obviously we limited, and you can see, given the constraint optimizations that Wilshire used, it's going to lean towards whatever the lower constraint is on public equities. So if we constrain it at 40 all the way down to 40, it's going to reduce that public equity allocation down to 40%. If we constrain it at 45, no less than 45, it's going to go down to 45. So whatever that minimum you put on that side is where it's going to allocate. I think given our outlook, again, lower risk portfolio A tends to align with staff's view pretty well as far as where opportunities are in the current market as we look forward. And again, it appears to be a relatively substantial change to the specialty credit. But again, I go back to it, it's moving back towards where we were before we made the last allocation. Dr. Hackbart, the last allocation for public equity was a change from, I believe it was 43.5% to 50% was the change in the last IPS allocation. Just, I know you had asked that. So I think we wanted to present options here, different options, and obviously moving, especially in the alternative asset classes, the private asset classes, come at cost and take time. So we wanted to present options that we thought we could implement, hopefully much more quickly than the last round of
You're fading in and out on
changes
my
made. Sorry,
computer. Is everyone else, can everyone else hear Steve?
Yes.
So I don't know, David, do you want to add anything to the two portfolio or allocations that were proposed? I think that covers kind of what our thoughts were in
Yeah,
presenting.
sure. I mean, I'll just add, as Steve mentioned, we had several meetings with staff going through this back in the fall, and in the modeling, a lot of other positions along that risk spectrum were looked at, a lot of different policy mixes. Both of these, our focus was, if you remember back to earlier last year, before we even stepped into this, we said there is an opportunity. We've said this to all plants. There's an opportunity today to have a better trade-off of risk and return, given how market regimes have changed. So if you're seeking higher return, that would be one approach to that. If you want lower returns, that'd be another approach. The approach here was that we can achieve these same expected returns with less risk. And overall, not just volatility. So both A and B were policies that achieve that. And, these were presented for you to think about. B is a little more of a risk reduction than A. So, and you can see there are just modest changes between the two, but they both are options for you to think about. And as Steve said, A aligns more with how the staff is thinking about implementation, et cetera. And so, both of these do achieve that objective, just to slightly differing degrees.
Can I ask you to go and review a few slides real quick, David? I think
Sure.
I guess the first one I'd like you to go to is go to slide 13, the actual recommendation, or the two options.
Yes. Yep. Would you like me to walk through these?
Well, yeah, go ahead and walk through them, but I particularly want to go down to, I want to pay particular attention to the second to the last bullet point.
Yes.
Next
Okay.
bullet point, excuse me.
Yep. Yeah. These are essentially summary points from what we just walked through on slide 37. So lower risk policy A, lower expected risk by just over 1% annualized relative to.
All right. That's where I want to stop. Lower risk by 1%. Define that. Are you talking about a 100 basis point drop in the Sharpe ratio or standard deviation? What are we talking about there?
In this case, that's 100 basis point drop in the standard deviation of return. So
from where to where?
So back on 37, we drop back to 37 for just a minute. We can see that's if you go all the way towards the bottom and you see the 109 in parentheses, that's the 109 basis points drop in standard deviation in the volatility level. And you go right up above that, you'll see it's from a 12.82 for the current target over in the first column to an 11.73.
All right. So you're talking about, see if my math is correct here. Now, I did graduate from UK, Dr. Packard, so hopefully it'll be
That's
right.
good. Not from Tennessee.
Um,
Yeah.
What you're calling a 1% drop in risk is not a 1% drop in risk. It's a 100 basis point drop in the standard deviation. So
That's right.
it's really over an 8% drop.
Yep.
in risk.
Yes.
So what I hear you telling me is we can get the same amount of return with nearly 10% less risk.
Yes.
That
On a relative basis. Yes.
okay. Next slide, I caught my attention because I don't know that I'd seen it. I'm sure I have and just didn't think about it. But slide 15. No, that's not the one. Try slide 30. I think that one may just be for the insurance pool, but if I understand what you're telling me there over the next, 10 years or so, the difference between contributions and the benefits paid out means money's going to have to come from somewhere, right?
Yes. Yes, exactly.
So it's going to come from the portfolio, correct?
Yes.
So risk from the standpoint of standard deviation is one thing, but we really also ought to be thinking about risk associated with sequence of return. Should we
Yes.
not?
Yes. And we do, and we do in this modeling, in the simulations that are
Just for everybody's understanding, can you give us a quick definition of sequence of return risk?
Sure. Yep. So as we've talked about that 6.95% annualized return over the next 10 years, when we forecast that over 10 years, we recognize that because there is volatility given any policy, there's volatility. That means that every year those returns differ and can differ quite a bit year by year. But on a path of 10 years, we're expecting those to come out to that 6.95, just under 7%. How you get there matters. And the sequence of returns is there can be, just like last year, 2023, the US equity market was up over 20%. And in 2022, it was down over 20%. So that sequence of returns is that all those different things can happen in a short-term period, year by year. That's why, number one, this is a very good chart to point out, you have to generate cash flow out of this portfolio. And these red bars are what you have to generate year by year. And those get past $100 million year by year. That sequence of returns, when you're taking that 100 million out each year, it may be a year when the portfolio has had a negative return, but you still have to pull cash out. And when you pull cash out, you've in a sense sort of locked in those losses because that cash is now left. That cash doesn't have the chance to bounce. So one, that's why volatility matters to you, because the less volatility you have, the more you can weather that sequence of returns. And then secondly, it relates to the drawdown risk that we show in those simulation charts deeper in the deck, that as markets sell off, you have to deal with that because you're generating cash flows and you have to pull cash out of the portfolio during those sell-off environments. So that's why the downside risk measure is important. The simulations are important because we get at thousands of different sequence paths to get to that 10-year expected return. And this is the projected cash flow from an asset pool is one of the most important things to look at. This is a good chart to point out for that reason.
I believe there was a study out just a few years ago that I've read several times over, find really interesting, that if you can eliminate 100% of the risk of the S&P 500, but capture 57% of the return of the S&P 500 over a long period of time, meaning 10, 20, 30 years, you actually outperform the S&P. Doesn't that basically go to the benefit of eliminating risk
Yes,
and
right. Anytime, yes, exactly. Anytime you can get there on a smoother path, you're better off in those individual years when you have to generate cash flow.
and
There-
that basically goes to the issue of sequence of return.
Yeah.
There's a similar study that's done that if you eliminate a very few number of down days, you significantly outperform, which is the same thing. And to Dr. I apologize, I had to switch to my phone. My internet connection went down. But to Dr. Hackpart's earlier point, I think if we look at that the chart that David mentioned with the colors on it, how have we done with that over allocation to public equities? And if we look at from a return standpoint, being down 20%, 19+% in the first year and then recovering 26% is actually flat, right? I mean, because your base for earning that extra return in the following subsequent year is on a lower asset base. So it takes a much greater return even to get back to flat.
Yeah.
Well, I know everything that I'm seeing and everything that I'm reading, I'm implementing with my clients. We're going through the same process, simply from the standpoint of being able to capture the same return and lower risk. So I'm certainly not down on public equities or private equity or anything like that. But if you can generate a 6, 7, 8, 9, sometimes 10% dividend rate within some of these specialty credit areas, that gets us where we need to be at that 6.5% rate or better. And I'm all about lowering risk and getting the same return for sure.
Well, I like to boil things down into very simple concepts that I can wrap my arms around. And so the message I'm hearing is equity is very pricey. And so the opportunity for a correction is there. And core fixed income has risen, and specialty credit seems to be a rising star due to banking regulations that have been explained to us. Since core fixed income is rising and has a great risk factor, and yet the risk A has it as flat, is that because it suppresses the overall return when you model it with an increased weight?
I'm sorry, Bill, I'm not sure I followed that question. Could you just repeat that part again?
Well, I rambled, but if core fixed income rates are increasing and has a very favorable risk factor, then why are we keeping it flat? Is it because the core fixed income, when you model it, reduces your total return?
There's a mix of that going on, and you're only, if you look at lower risk A and B, these are two positions on a risk spectrum. So in A, you've moved down just 109 basis points in risk. With these constraints, it's still allocating just 10% to core fixed income, and it's allocating to the other areas you can see. If you move down further on that risk spectrum, you see core fixed income goes up. So none of these numbers are just plugged in by us, but these are the outcome of the optimization process. So if you were to keep moving down that frontier, another 300 basis points in risk, et cetera, you would see a whole lot of core fixed income and cash come into that mix. So this is just about where on that spectrum we've landed. And, and that's really the discussion. How much do you want to reduce risk, for similar returns? Or, if you reduce further, you'd start to reduce return a bit too. But these are the areas that we landed in that discussion.
I thought your slide 36, the efficient frontier was really telling.
Yeah, that's a good one. We haven't even gone there today, but you're absolutely right. Yeah.
Well, I think I'll answer my own question, but for private equity, which has a high risk factor, and we're not moving, we're actually increasing where we are today. So I guess, the public equity has a less risk factor than private equity. So I guess there's trade-offs on return there as well.
Private
Yes.
equity goes down in both of the lower risk portfolios, correct?
Well, I've got us at 7% now, and the risk A is 8.
10%
B is 7.
Yeah.
I'm talking about where
The current
we
target
stand.
is 10.
I agree. I'm just talking about where we sit today.
Right. So our focus here was on a policy decision, and you're right. You sit closer to these allocations with some of these asset class current allocations. The focus of this whole study is just on the policy, but yes, you're closer to that A than you are your current in some cases. So in other words, the decisions for you are about policy, current target versus lower risk A target or lower risk B target.
Other questions or comments? In terms of reducing our focus on public equity relative to some of our peers, we are still probably on the low side, at least compared. Am I correct in that?
We have a slide
So-
for that.
When you look at the broad universes of public pension plans, there are many in those universes. I mean, we study this data on a regular basis. There are many funds in those universes that are not as well diversified and therefore are relying quite heavily on U.S. equity in particular. Your target allocation of 50% is actually not lower than many of those medians. Some of the really, more diversified plans are lower than you are. So, but there's a lot in those peer universes that there are many funds in there that are pretty heavily reliant on a few major asset classes. And it's just the way it continues to be.
Right. I think that's the case. What I've been able to determine is that we are on the lower tier of allocations to public equity. And in terms of overall performance, I think we look back historically, many of those have actually done better than we've done.
Yeah, it's
Overall, okay.
I'm sorry. Go ahead.
In terms of overall performance, I think those that are more heavily weighted toward public equity have outperformed our portfolio. That's the comparison I think is important as well.
I think Steve's trying to say something, but it's cutting out.
Yeah, Steve, you're not coming through. Sorry about that. Yeah.
If I could, Dr. Hackbart, to the point that you just made, concerning a number of plans having a larger allocation to particularly public equity. I think that's why when you look at our standard deviation and particularly our Sharpe ratio, why we excel, because we're getting best in class returns with a minimal amount of risk. So our risk adjusted return, as was shown through this quarter Sharpe ratio, is off the chart. I would think that there would be a number of entities who would hope they had the kinds of returns that we've been able to get with taking the minimal amount of risk that we've taken. So there are
I understand that. I understand that, Ed. I understand.
Okay.
Any other comments or questions?
I was just sitting here looking at slide 77. I don't know whether Dave, you want to touch on that one or not.
Oh, right, yeah. Yeah, this is just a
We've been in a very
Steve, I'm sorry, we still are not. I know you have something to contribute, but we're not getting it unless someone else is.
I can't pick up anything out of it.
Yeah, there are a number of, I'll just add there, this is a good point. There are a number of charts that we could show that show the current valuation of US equities to be expensive. So, and this is one of those. We're not by any means with this policy work suggesting that you do something tactical and in positioning about that. This is just the allocation work here is about the policy that you put in place based on the next 10 years of expectations. You'll also continue to revisit that policy as you go forward. It's not as though you put that in place today and step away from it for 10 years.
Yeah, I think we only historically tend to change our general policy at fairly infrequent intervals, I believe, right? Every 3 or 5 years, we actually do a serious in-depth analysis, but we did make a change a couple of years ago, which was ended up being a positive change.
Yeah. Right. Yeah. So our recommendations are generally about every 3 years or so, but depends on what kind of factors change. If demographics of your liabilities change, that's often a reason to revisit it. And also when markets change significantly, which they have over these last 3 years, really in 2 completely different regimes, much having to do with the Fed, and with the Fed having created an easy money supply for well over a decade, and then hitting COVID and creating it again, and now resulting in pretty rapid inflation and trying to work their way out of that. Those elements, which are real, have changed the forward-looking regime quite a bit. And all we're trying to do is, from an asset allocation perspective, be thoughtful to what those expectations are going forward.
Yeah, I think Steve was trying to say that a lot of plans are above 7% returns, and maybe that's more doable now that rates are not zero. But I think a lot more plans are coming towards us because of the de-risking, right? If you get, it's like Lyle said, if you can get the similar or better return for less risk, why not? So I think that is generally where people are going, both across consultants and other plans peers. I think, we probably get an email every day about other people expanding their private credit allocation, their rosters. Obviously, we've been there for a while and are pretty experienced in this area, but other people are initiating allocations to that. But I think it's just because it's a similar dynamic. And I know that, like, I think it's been said several times today, this isn't a tactical call. But it's done periodically every few years with a long-term focus, but especially after things materially change in the market, which obviously the rate environment has now. So, yep.
And Dr. Hackbart, if I may, I think the slide that Mr. Romero was referring to earlier about what the current asset allocation is on 162.
Okay, thank you.
And that talks about also the minimum and maximum allocations and the target allocation.
Right.
Or at least it's, yes, at the bottom. Thanks, Sherry.
Yeah, 131 has it as well, but that has it in a different order, but it's still the same information.
You finished?
I just went through, I guess probably did the same thing Bill did as far as looking to see exactly where we're at. And from what I'm looking at as far as the constraints, I don't know, you know, if we chose to go to that lower risk A recommendation, once you look at the constraints around it, I'm not finding anything that would be out of those constraints right now. Is that what you saw, Bill?
I did. You know, the specialty credit, it'll bring it into compliance basically to our current holdings. And private equity, it would be within 1%. The equity would have to be reduced. That's the whole point.
So if you look at the constraints, if I'm reading this correctly, you're looking at the target might be 45, but maybe I'm looking at that.
No, you're right.
If you got a 10% variance between the two.
The statement earlier, though, that whatever the minimum is, that's what would be the actual. So is that the policy?
There's something I might need to clarify here if I'm understanding this correctly. These constraint columns, optimization constraints, I don't know if anyone is perceiving those to be your ranges around the policy. That's not what those are.
No. Those were what Wilshire put in to make that happen, because the 40, if we're looking at, I don't know if we're on 30, if we're on 37, like the 45 to 80 that is used to make lower risk A, and the 40 to 80 that's used to make the public equity allocation for lower risk B. That's the stuff Wilshire put in, because without those constraints, it would be zero or less.
I understand that, but while they may not be the range, just because the portfolio is built with those constraints, it still theoretically is the range at any given time.
Well, that's just for my, is what I'm hearing.
Yeah.
Well, we would implement similar to the current IPS. Is that bad? Sorry.
I'm afraid Steve's in the middle of this storm. We can't understand
I see him on the screen. If you would unmute the other one, maybe
You're back, Steve.
I just deleted the last one, so he should be fine.
Is that better?
there you go.
All right.
Yeah,
So the ranges that we would have specific to those targets, either lower risk A or lower risk B, would certainly be tighter than those optimization constraints that you see. So we would not be operating in a range for public equities of 45 to 80% or 40 to 80%. It would be 5% on either side of that, kind of more of a range.
I understand that.
Okay.
But
Steve, could you?
Our policy ranges may be different as far as construction of the portfolio. These optimization ranges, the system basically took those ranges and said, all right, what's the optimal level? And it said
Correct.
45%.
Yes,
So
within those, yes, you're correct. And as we talked about on
so
the,
if that, I'm still going to assume our policy ranges need to be tightened up. I understand that, but my point is based on the portfolio construction, we are within all those ranges, given how we are currently allocated.
Correct.
So, you know, with that in mind, you know, and given, you know, the ability to move in the ranges that we need to probably tie down closer, I would certainly support, you know, going to a lower risk A profile.
Steve, if we were to go with one of these recommendations, what would be the process that you would go through to move from our current allocation for public equity to the other allocations?
We're
And
well,
what
we're
timeframe would be involved in it? What would be the process?
you know, as Lyle mentioned, we're relatively close to those allocations currently. The actual portfolio allocations are a lot closer to those targets. We're going through a similar process with KRS, especially on the public equity side. And what we've been doing is you know, as opposed to doing a wholesale trade to chop a significant portion of public equity down, we're kind of doing it in a stepwise fashion. We're trying to be prudent, take pullback opportunities.
Lost him again.
We lost him again, right? Yeah. Is it stormy?
We're having like power issues. Mine's gone
Power
out twice
issues?
during this
Okay,
call,
all right,
so
okay.
and the internet as well. But I think he was trying to say that rather than just do it all in one shot, we've been doing it gradually. You know, as the markets have fluctuated. And I think Joe, I don't know if Joe wants to speak more to that, but I think they've just been doing it gradually as, you know, with the markets as they move, and rather than just one day decide to lop off a lot of exposure.
What would be the general dollar value if we move from 50 to 40, for example, for public equity? That would be a fairly significant.
Yeah, that's exactly right. I mean, that's why just like the moves last time to increase real return and things like that were significant, right? So we're talking 10% of the portfolio, 16 billion, just ballpark $1.5 billion or so. I mean, obviously in liquid public markets, that's easier to do than, you know, in other areas, but yes, it's something that you would want, yeah, we would, you know, probably be, that we'd be stepping towards like we have been.
Right. I was just going to say that it would be a stepwise thing as opportunities came about. That it is a significant move. It would not be done at one point. You subject yourself to some pretty significant timing risks. So we would likely limp into that, and so it would be done over several allocation shifts. Probably over a fairly extended period of at least a few 2-3 quarters, I would think, to get it completely taken care of. So
We've been going for almost 2 hours, and I know that we're probably intruding on people's times. Have we covered the topic pretty well? Any other residual questions or clarifications anyone would like to offer? Or are we about to move to making a decision whether we're like to move on these recommendations today or delay, or what's your pleasure?
I would think the investment office would like to see, you know, get an idea of where we're going. I would certainly feel comfortable making the motion that we, you know, make the move as far as our targets anyway, to the lower risk A recommendation. And then I'd like to also see at the next meeting, you know, what those optimization ranges are for each of those asset classes and make sure they fit. But, you know, we really wouldn't be making any changes versus where we're currently allocated.
Except for public equity, right?
Well,
yeah,
not really. I mean, we're still within the ranges. I mean, we're
within the range, but not in target
Yeah, I mean,
target, right?
We're out of the, you know,
Mhm.
we're 51%, and the lower target would be the target would be 45. You know, from a dollar figure, I was just punching numbers. You're talking about a less dollar figure difference than what we were dealing with when we made the move with the Lord Abbott by half.
Yeah.
So, you know,
Did you want to make a motion accordingly, Jordan?
I'll make the motion, for no other reason, just to kind of move it down the field a little bit. But yeah, I'll make that motion that we look to change the allocation of the recommendation of lower risk A. Same return, 8% less risk. I think that'd be prudent fiduciary choice.
So the motion's change the targets, right? Okay,
Correct.
the range, is that correct?
The target. Yes, sir.
Is there a 2nd?
I'll second.
Okay.
I'll second now that I know that we're already at 20% in specialty credit. That makes a big impact to me to see where we are now versus what our current target was.
Any further discussion? We'll proceed to vote. Those in favor, please signify by saying aye.
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 Opposed? I vote no. Motion carries. I think we've probably used our time. So Ed, maybe we might want to delay your presentation about the strategic planning process, if that's okay with you.
Absolutely, sir.
Right. Okay, so I think that concludes our agenda. Certainly, Steve and David, thank you for your presentations, and Anthony for your contributions as well, and members of the committee. I think we've had a good, thorough discussion. And as my understanding, then this will go to the CERS board. Is that correct?
Correct.
Correct.
Right, okay. With that, I will assume that the meeting is adjourned.
Thank you.
Thank you.
Thank you very much.